Good morning. It's Monday, August 7th, 2023, and I'm Jared Hall with Harvest Investment Strategies, and you're watching The Week Ahead, where every Monday we update our clients and network on what could be impacting financial markets during the week. Before talking about this week, I think it's important to unpack some of the news that moved the stock market last week. Last Tuesday, the credit rating agency Fitch's downgraded the U.S. credit standard from AAA to AA+. Some of you may remember the last time the U.S. debt was downgraded back in 2011, but let's have a refresher and unpack that story a bit. Fitch's, Moody's, and Standard & Poor's are three of the largest credit rating agencies in the world. These agencies provide ratings for various entities, including governments, corporations, and other various financial instruments. Their primary function is to assess the creditworthiness and risk associated with these entities to help investors make informed decisions and promote transparency in the financial markets. Tuesday, Fitch's downgrade on the U.S. debt was based on their continued concern about the debt ceiling brinksmanship we've seen, a broken budget process, and rising debt levels. The rating change was not taken without some criticism, and even Treasury Secretary Janet Yellen cited it as being baseless and backed by old data. Nevertheless, this news sparked a quick market sell-off, albeit somewhat muted compared to the market reaction that occurred in 2011 when the S&P index fell nearly 10% in the week after. Last week, the market had its first weekly decline in 4 weeks, but only pulling back 2.3% in total. In addition to the debt ceiling, we had July jobs data released on Friday showing fewer people than expected began working last month, as an acceleration in service industry gains was partially offset by a slowdown in the goods producing sector. We also saw June's employment data get a negative revision. This week, the market will try to recover from last week's news, but the near-term price action of the market would leave us with a cautious tone. 85% of the S&P 500 firms have reported Q2 earnings over the past couple of weeks, and the blended growth rate is down 5%. That's the steepest decline we've seen since the third quarter of 2020. Given the lack of earnings conviction and the strong run-up the S&P's made since the middle of May, we'd encourage investors to remain patient for the next wave of positive market movement. This week, the markets will have more inflation data to consider, along with the Federal Reserve, when the CPI for July comes out Thursday. Following that release, we have July's Producer Price Index on Friday. Earnings season is drawing towards a close, with only 33 members of the S&P 500 set to report this week. Thanks for watching this video and following along. If you want more information on the U.S. downgrade, debt downgrade, or other financially savvy ideas, follow us on LinkedIn or Facebook.